Welcome to Earnings Recap. Today we're covering Tyson Foods' second quarter 2025 earnings report and call.
And there's an interesting non-financial bit right off the bat.
Oh yeah, what's that?
Well, Tyson mentioned they're actually ahead of schedule removing those petroleum-based synthetic dyes from most of their retail brands.
Ahead of schedule. That's good news for cleaner labels. When are they expecting to finish?
By the end of May, apparently. It definitely shows they're listening to consumers, I think.
Interesting. Okay, so, like we always do in these deep dives, we're going to break down this earnings report and the investor call.
Yep. Translate it into plain English for you.
Exactly. Our goal here is really to pull out the most important bits, the key insights and takeaways from Tyson's Q2, so you can get a quick handle on what's going on with their business.
All right, let's dive in, starting with the big picture numbers for the quarter.
How did overall sales look?
Came in at $13.074 billion, which sounds pretty much flat compared to last year.
Flat, okay. But wasn't there something specific impacting that number?
Yes, exactly. You have to remember that number includes a $343 million hit. It's about 2.6%.
Okay.
It's from a legal contingency accrual, mostly hitting the pork segment.
Yeah.
So take that out, and sales probably would have grown like they expected.
Ah, okay. So that legal item really dragged down the headline sales number. What about profitability, though? Adjusted operating income.
Now, that's where the story gets a bit brighter.
Yeah.
Adjusted operating income was $515 million.
And how does that compare?
That's up 27% year over year. A pretty solid jump.
And margins?
Margins expanded too, up 70 basis points, hitting 3.8%.
So better profitability even with flat sales.
Right. And importantly, this is the fourth quarter in a row they've grown sales, adjusted operating income, and adjusted EPS compared to the prior year.
Fourth quarter straight. That suggests some sustained momentum, doesn't it?
It definitely points towards a positive trend in their core operations.
Okay, let's drill into that adjusted earnings per share number then.
Adjusted EPS came in at $0.92.
Yeah.
That's up a very strong 48% from last year.
48%. Wow. So the underlying profitability really improved. But what about the GAAP numbers? Usually a different story there.
You got it. Big difference. GAAP operating income was actually down 68%, only $100 million.
Ouch. And the margin?
Just 0.8%, very thin.
And GAAP EPS.
That fell even harder, down 95% to just 2 cents a share.
2 cents. Okay, so that GAAP versus adjusted difference is huge this quarter. Really shows the impact of that legal charge and maybe other items.
Precisely. The adjusted figures strip out that noise and give you a clearer view of the ongoing business performance.
And which parts of the business drove that adjusted income growth?
Well, the good news for them was that chicken, pork, and prepared foods all delivered year-over-year growth in adjusted operating income.
Okay.
Their international division did too. So that strength across those segments helped offset the decline they saw in beef.
Ah, so beef was the weak spot, but the others carry the weight on the adjusted side. Makes sense. How's their financial health looking overall? Balance sheet stuff.
They seem to be making progress there. Their net leverage ratio improved compared to last year.
What's it at now?
End of the quarter at 2.3 times. Lower is generally better, shows less debt relative to earnings.
Right.
And they mentioned having $3.2 billion in liquidity, which is, a good cushion.
Any moves on the debt side?
Yeah, they actually paid off a $750 million term loan early. It wasn't due until 2026.
Proactive move. So, strengthening the balance sheet. Okay, so overall, flat sales due to the legal thing, but improving adjusted profits and a better financial footing. Let's dig into the segments now. How about prepared foods?
Prepared food sales were basically flat year over year. They got higher prices, both in retail and food service.
But volumes were down.
But volumes were softer, yeah, so it balanced out. But the interesting part is their profit.
How so?
Adjusted operating income was up almost 5%. And margins expanded by 50 basis points to 10.2%.
10.2% margin in prepared foods is pretty healthy, isn't it?
It is. It suggests they're managing things well. They pointed to efficient marketing and SG&A spending.
Cutting overheads.
Seems like it. Plus, better operational execution and the pricing power we mentioned, that helped them fight off higher raw material costs.
Did they mention specifics on the operational side?
They did, actually.
Well,
they talked about new tools giving them better visibility, like right down to the process level on the production lines.
Ah, more data.
Yeah. And they said this led to real improvements, 250 basis points in line efficiency and 280 basis points in labor efficiency.
So that tech investment is paying off directly on the bottom line. What about new products in prepared?
They highlighted some innovation wins. Apparently, their Jimmy Dean chicken biscuits won an award.
Okay.
And they're expanding lines. Right brand, moving into smoked sausage, Hillshire Farms, snacking growing. stuff like that.
And the outlook for prepared foods.
They sound pretty confident. They expect to actually exceed a 10% return on sales going forward.
Driven by
More innovation, getting products into more places, distribution gains, and just continuing to run things better operationally.
Okay, sounds like a solid segment for them. Let's switch to chicken. You said that was strong.
Very strong. Best second quarter adjusted operating income in 9 years. It nearly doubled year over year.
Doubled. Wow. And volumes.
Volume was up too for the second quarter in a row, up 2%, which helped push sales up 2% as well.
So what was behind that big jump in chicken profit?
Two main things, really. Strong operational execution. They mentioned having their best order fill rates in years, meaning they delivered what customers ordered very reliably.
Okay, running smoothly.
And the second big factor was lower grain costs. Feed is a huge expense in chicken, so lower prices there really help margins.
Makes sense. And strategically, what's the focus in chicken?
Building long-term customer relationships, they said, and shifting more towards value-added products.
Things like marinated chicken, pre-cooked stuff.
Exactly. Stuff that typically carries a higher margin than just basic chicken parts.
And the outlook for chicken, do they expect this to continue?
They sound confident about the market and their progress, saying it's sustainable.
Yeah.
They also flagged they'll be making some investments in the second half of the year.
Investments in what?
To boost their market share in those value-added areas, both for retail and food service. So maybe that tempers the profit growth slightly later in the year.
Could be.
And they mentioned their pricing models are often linked to grain markets, which helps them aim for more stable margins over time, sort of hedging their bets.
Okay, interesting. So, strong chicken performance expected to continue, but with some investment planned. Now, beef. You mentioned that was the tough spot.
Yeah, beef was definitely the challenge this quarter. Sales were actually up a bit.
Oh.
Higher average prices per pound. Demand for beef is still pretty healthy, it seems. But volume was down slightly, about 1.4%.
Okay, so prices up, volume down a touch. What was the profit issue then?
Spread compression, that's the key term here.
Meaning the gap between cattle cost and beef price.
Exactly. Cattle costs went up significantly, squeezing that spread. So even with higher beef prices, their profit got hit hard.
How hard?
Adjusted operating loss of $149 million.
Loss. Compared to last year.
Last year was also a loss, but smaller at $34 million. So it got quite a bit worse.
Despite that consumer demand being resilient.
Yeah. They said demand is holding up, especially for middle meats, steaks and roasts, and ground beef.
Any other factors in beef?
They noted cattle weights are at record highs, which helps offset some of the lower number of animals processed. More beef per animal.
Right.
And interestingly, they're seeing early signs that ranchers might be starting to rebuild herds. Lower cow harvest, keeping more heifers back for breeding.
So maybe the bottom of the cattle cycle is getting closer?
That's the hope, I think.
Yeah.
That maybe costs will eventually ease up. But it's a slow process.
Definitely something to watch. Okay, let's move to pork. How did that segment do?
Pork sales were roughly in line with last year if you ignore that big legal accrual we talked about earlier.
Right, got to exclude that volume and price.
Volume was down about 3.8%, but average prices were up 4.3%.
Okay, mix there. And profitability.
That was the good news. Best second quarter adjusted operating income in 3 years for pork. Up 67% year over year.
67% increase. That's a big swing. What drove that?
Similar themes, operational improvements, and also pushing more value-added products in their mix.
So, getting better margins despite some pressures.
Yeah, they said those factors helped offset tighter spreads and higher hog costs, and they see healthy demand ahead for pork.
So, chicken and pork doing well, beef struggling. What about the smaller international other segment?
That showed really strong improvement. Adjusted operating income hit $53 million.
Compared to?
Just $14 million last year. They called it their strongest quarter ever for that division.
Wow. Why the big jump?
Better operational fundamentals, they said, and their commercial growth strategy playing out in those markets.
Sustainable.
They expect continued good performance, but they did flag potential macro headwinds in some international markets later in the year. A bit of caution there.
Okay, so a real mixed bag across the proteins. Let's zoom out a bit. What about their bigger strategic initiatives and the overall outlook for the rest of the year?
They're really hammering this theme of operational excellence. Still optimizing the plant network for efficiencies, trying to reduce capital spending.
Right.
And a big one is this logistics and distribution transformation.
What are they doing there?
Selling off their smaller, older cold storage warehouses. They expect $250–300 million in proceeds from that.
And replacing them with?
Transitioning to fewer, but much larger, highly automated facilities. It's a big strategic shift in their supply chain.
Sounds expensive up front, but what's the payoff?
But they're projecting about $200 million in annual savings by 2030 from this.
Oh,
Reducing complexity, streamlining inventory, just simplifying how they move products around. It's a long-term play for efficiency.
and we already mentioned the product portfolio stuff like removing dyes.
Right, being proactive there. So, with all this going on, the mixed Q2 results, the strategic shifts, did they change their financial guidance for the full year? Interestingly, no. They kept the full fiscal 2025 guidance exactly the same.
Really? Even with the strong chicken performance balancing out the beef losses?
Yep. Still guiding for sales flat to up 1%, which includes that legal contingency impact we discussed.
Okay.
Adjusted operating income still forecast between $1.9 billion and $2.3 billion.
And CapEx and cash flow?
Also unchanged. CapEx, $1.0 to $1.2 billion. Free cash flow, $1.0 to $1.6 billion.
Holding steady on the outlook. What about external risks like tariffs? Did they talk about that?
They acknowledged the uncertainty there and also from consumer pressures. They said that's factored into the guidance they just reaffirmed.
Do they expect tariffs to change global protein demand?
Not fundamentally, no. But they do see potential for short-term disruptions as trade flows kind of readjust.
And they have plans for that?
They said they have contingency plans ready to try and minimize any impact. Being proactive.
Okay. And finally, shareholder returns. What's the plan?
Still committed to the dividend as the main way to return cash. That hasn't changed.
And leverage targets. Acquisitions.
Leverage target is still 2.0 times net debt to EBITDA. And they're open to bolt-on acquisitions, especially in value-added areas. But they stressed they'll be selective and disciplined about it.
Okay, so no big shifts in capital allocation policy. Looking back then, how would you sum up Tyson's key strengths right now?
Well, definitely the strong performance we saw in chicken, pork, and prepared foods. That diversification is helping.
Right.
The progress on operational efficiencies seems real, driven by tech and process improvement.
And adapting to trends?
Yeah, being proactive on things like protein demand and cleaner ingredients like the dye removal. And those big strategic initiatives like the supply chain overhaul show long-term thinking. Plus, the balance sheet is solid.
And on the flip side, the weaknesses or challenges.
Beef is the big one, obviously. Those losses due to high cattle costs and spread compression are a major headwind.
Still a big part of their business.
Absolutely. And then there are those external uncertainties, tariffs, consumer behavior, ongoing raw material cost pressures in some spots. Lots to navigate.
Beyond the numbers, what was the vibe? The non-financial stuff. Management tone.
Management sounded pretty confident. Confident in their strategy, their execution, their ability to handle this dynamic market. Lots of emphasis on operational excellence and long-term value.
And the strategy itself.
Still focused on that multi-protein, multi-channel portfolio, trying to meet diverse consumer needs. Plus, innovation, operational improvements, customer relationships. The core pillars seem unchanged.
Did you get a sense of how analysts reacted on the call?
It was interesting. Quite a few analysts seemed to push back a bit on why the full-year guidance wasn't raised.
Given the strong first half, especially in chicken.
Exactly. It suggests maybe some skepticism out there, or at least a feeling that management might be being a bit conservative, perhaps given the beef challenges and tariff uncertainty.
And any other news points?
Just reinforcing that non-financial highlight about the dye removal, getting that done early, is definitely a positive PR point for them, showing responsiveness to health trends.
Okay, so putting it all together, what's the main takeaway from Tyson's Q2?
I'd say it was definitely a mixed quarter. You had real strength and profit growth in chicken, pork, and prepared foods, which is great. But that was significantly offset by the ongoing deep challenges in the beef segment.
So the diversification helped, but couldn't entirely cover the beef issues on the Gap side.
Right. But their strategic initiatives are moving forward, like the supply chain work. And management seems cautiously optimistic they can still hit their full-year targets, despite all the headwinds.
All right, that brings us to our final thought for you, the listener. As Tyson navigates all these shifting market dynamics, investing in efficiency, adapting to consumer tastes, how might the balance of power, or maybe the profit contribution, shift between its big protein segments like beef, chicken, and pork in the years ahead?
And what could that mean down the line for consumer choices and, maybe just as importantly, the affordability of protein on our plates? Something to think about.
Definitely. Well, thank you for taking this deep dive into Tyson Foods' latest earnings with us today. We hope these insights give you a better handle on what's happening within the company and the wider food industry.